FHA loans, a fantastic option for not just first-time homebuyers, for really anybody who's looking to buy a home, who wants a low down payment option and a lot of flexible credit options. So if you have credit that's even all the way down to a 500 credit score, you could go FHA. So in this video, we're going to talk about so many facets of FHA. There's going to be a little scroll bar along the bottom here, so you can fast forward to different sections if you want to find just the information that you're looking for, but you're going to learn a ton about FHA loans so you can make the right choice when you're purchasing a home. Choosing the right loan is going to help you save the most amount of money possible moving forward and help you win the house that you love. So let's talk about an overview here with the FHA loans. So FHA loans are insured and backed by HUD. Now, what do we mean by insured? This is only insured for lenders. So basically what it's saying is HUD is going to come in and they're going to insure the loan. That way, if somebody defaults on a loan or goes into foreclosure, they're going to give the lender that money back. Okay, so it doesn't do anything to protect you, but since lenders have less risk, they can pass on some cost savings to you. And that means the loans can be a little bit more risky. What that means is they'll lend on a lot more difficult loans that maybe a conventional loan wouldn't allow. Okay, so they can be a lot more flexible than other types of loan programs because they are insured. And FHA was started as a means to help people who couldn't qualify for conventional. Conventional typically started out at least being around 43% debt to income ratio and needing 20% down. Most people couldn't fit in that box. So that's why FHA was created. Now, this is not just for first-time buyers. This really is for anyone who wants an FHA loan. There are construction loans available. We're not going to cover that in here, but it's a very standard, the qualifications to get a construction loan, to purchase land and build a home, as with purchasing a pre-existing home. Okay, now FHA tends to be the best for lower to mid credit scores and should not be a long-term loan. Okay, so low would be on the 500 range, mid would be mid 600 range, and FHA is not long-term because there's really costly mortgage insurance. And we'll talk about the costs here in just a little bit, but really you shouldn't be carrying an FHA loan for longer than you need to because it can be costly. It can be a good option short-term, but long-term probably isn't your best option with financing. And also, FHA loans tend to be overlay stacked. So basically the way overlays work is FHA sets out their set guidelines, okay? And that's the base rules that they have. And then lenders are allowed to tighten those up if they want to. They can add rules on top of the rules that FHA already has. And this is what's called an overlay. And FHA loans tend to have a lot of overlays with them because FHA has pretty lenient standards, and then the lenders want to take on a little bit less risk than that. A good example, and we'll talk about here in just a second with COVID, is the minimum being 500, and a lot of lenders saying that the minimum is now 640. Okay, so let's talk about some COVID changes that have happened here with FHA. So one of the biggest changes that I've seen with COVID is that lenders have put on an overlay, and not all lenders, but most lenders have put on an overlay that says the minimum credit score is 640. And I even see people making videos saying, yeah, the new minimum credit score for FHA is 640. That's not true at all. It still goes down to a 500 credit score. It's just that some lenders are choosing not to do that. And with COVID, actually, most lenders are choosing not to do 640. Also, if you're self-employed, FHA wants evidence of ongoing work or current work in your organization. So they want some sort of proof that you're going to continue seeing income coming in with COVID. And also, this is an overlay here, but future income used to be allowed with FHA, meaning that you could purchase a home with a job offer and not be working there yet. However, with COVID, most lenders are not allowing that. They want to see you at work, normally enough to collect anywhere between 2 to 4 weeks worth of pay stubs to be able to qualify for a loan. Now, down payment and closing costs. This is one of the biggest things that we need to talk about here with FHA. All right, so the minimum down payment is 3.5%. All right, and the down payment is actually tied to the credit score. I'll talk about this here in a slide coming up. All right. You're allowed to use collateralized loans, so something like a 401k loan or a home equity loan to be able to qualify for the down payment and closing costs here. However, you can't use unsecured loans, right? I can't use a credit card. That's not something, I can't just go use a credit card for my down payment or closing costs. That's not allowed. I can't use a personal loan for down payment or closing costs. However, I can use a family member loan that can be either secured or unsecured, meaning they can either have claims to the property or no claims to the property with that type of loan from a family member. Also, we could get a gift from a family member to go towards our closing cost or down payment if we need some help there. There are also local down payment assistance programs and national down payment assistance programs where you're going to get help to pay for your down payment or some of your closing costs. The issue here is that they can be costly. I rarely have ever seen a down payment assistance program that is more beneficial for a buyer than if they fund the loan themselves, paying their own down payment, their own closing costs on their own. So something to be mindful of here. So credit requirements and down payment go hand in hand with FHA. So it goes all the way down to a 500 credit score, which is crazy because, it's hard to find loans or lenders who will go down to a 500, but FHA does. And if you're struggling to find a lender who's not going down to 500 with FHA, you want to shop around to find a lender that will help you out there. So if you have a 500 score up to a 579, you're going to need to put 10% down. Okay. And if you have a 580 plus, then you can do 3.5% down. All right. Now, FHA is one of the most lenient types of major loans. If we're talking about conventional FHA, USDA, VA, it's one of the most lenient types of those loans. And it tends to be best for scores below 680. All right. So technically you could qualify for a conventional loan if you have a 620 score. However, what I've found is even if you can qualify conventional, if you have below a 680, FHA is probably going to be a better route for you short term. Then you can build your credit score and refinance into a conventional loan. Normally, that's going to give you the best mix, the best loan strategy moving forward, instead of just holding on to an FHA for a long period of time or getting a conventional loan with a middle credit score that's going to cost you a lot of money because you're going to get penalized with the interest rate. So, credit events here. So, FHA loans are more forgiving on revolving and installment lates. Okay, they normally let you have around 2 lates within the past 12 months on revolving accounts and normally 1 installment late within the past 12 months. Ideally, you would have none, but FHA can be a little bit more lenient here. Also, as far as like non-medical collections, greater than $2,000 total. Again, this is non-medical. You either need to have one of these 3 remedies, either a payment plan, it needs to be paid off, or 5% of the balance is going to be calculated in your debt to income ratio. And this is going to shrink how much you can qualify for with a new home. So here's some waiting periods that you might need to wait for. So if you've had a deed in lieu, a foreclosure, a short sale, you need to wait 3 years from the deed transfer of those events. If you had a Chapter 7 bankruptcy, you'll need to wait 2 years from the discharge. And if you've had a Chapter 13 bankruptcy, you need 12 months of on-time payments and court approval to be able to get into an FHA loan. Now, rates. Rates with FHA actually are really low, okay? And this can kind of trip people up because they think, why in the world is FHA having such a lower rate? And it tends to actually have lower rates than conventional. We'll talk about a chart comparison here later on in this video. But the reason why there's lower rates is because it's backed by the government. Now, what offsets these low rates is high mortgage insurance costs, and we'll talk about that here in just a bit. So rates are similar to USDA and FHA. Brokers are going to tend to have better rates on FHA loans. And the reason why is because legally they can't take a difference in the risk-based pricing and pocket it themselves like someone like a direct lender or bank could. It doesn't mean all of them, all banks or direct lenders do that, but for the most part, if you're using an FHA loan or any government loan for that matter, brokers tend to have lower rates there. All right. And it's going to be easier than conventional to get lender credits if you need to. A lender credit is where you would increase the rate slightly to receive a credit towards your closing costs. And again, because FHA loans are insured and backed by the government, lenders take on less risk, meaning you can get a lower rate, meaning that there's more flexibility for the lenders to give you money towards your closing costs if you need it. So they would increase your rate slightly to give you credit towards your closing costs. Again, that's only if you want it, only if you need it. Now, mortgage insurance. Mortgage insurance is one of the most costly things about FHA. It is one of the biggest downsides. Like FHA gives us so much leniency and flexibility with how we set up this loan and who can qualify for it. But the big downside, the way that we pay for it is through mortgage insurance. And mortgage insurance is what funds FHA's ability to insure this loan for the lender. So FHA has two types of mortgage insurance. Number one, there's an upfront mortgage insurance, okay? And this is 1.75% of the loan amount. It's not paid up front, but it's going to be wrapped back into your loan. So if we were purchasing, if we had a $300,000 loan here, we're going to actually call this a loan and not a house. $300,000 loan, the mortgage insurance cost upfront would be $5,250. So instead of taking out a $300,000 loan, we're actually taking out a $305,250 loan. All right. And then also we have a mortgage insurance premium. Okay, this is similar to conventional's PMI, private mortgage insurance on conventional. It's basically the same thing on FHA, except they call it a mortgage insurance premium. It's 0.85%. So that would actually be $216 per month on a $300,000 loan. So FHA can have pretty intense mortgage insurance here. Also, mortgage insurance doesn't change based on the buyer. On a conventional loan, the higher your credit score, the less risky your loan is, the lower your mortgage insurance. On FHA, it does not matter if you have a 500 credit score or an 800 credit score. Your mortgage insurance is always going to be the exact same cost here with both of these types of mortgage insurance. Also, your mortgage insurance will not fall off at 20% equity. No matter how much you put down, they do not go off of equity with if your mortgage insurance falls off. In fact, it's going to stay on for the entire life of the loan. Unless you put 10% down, then it's going to fall off after year 11. So this is why FHA is not a good long-term loan option, but it can be a really great short-term option. And FHA actually works really, really well for people with low to mid credit scores to purchase a home, work on their credit, and then refinance into conventional. I'll talk about that strategy here in just a bit. So property requirements. This has to be a primary residence for a minimum of 1 year. You need to live in the home for a year, and then you can decide if you want to rent it out. Now, obviously, you can sell anytime you want. You can go purchase the home and sell 2 weeks later. That's no problem at all. But you need to live in there for a year if you're going to choose to rent it out and not sell it. House hacking is allowed. This is really common with FHA loans. House hacking is basically a way of using primary residence loans to try to generate some sort of rental income from them. So a good example with house hacking would be, you can purchase up to 2 to 4 units. So you live in one unit and rent out the other units. Okay, that's still primary residence because you live in it, but you're getting rental income from the other units. Another example is I purchased the home, 3.5% down. I live in there for a year, and then I rent out the property and I go purchase another home. All right, so I still have the FHA loan that still stays on there, where I have the lower interest rate. I didn't have to put a huge down payment for an investment property, but I now have rental income after a year of living in the home. So 75% of rental income is considered to go to offset your mortgage payment. Okay, and that's if you have other homes or if you're renting out other units. Something that can be really tricky with FHA loans is if you're looking at a condo, it has to be on a FHA condo approved list. All right. And this is where each condo individually is vetted for their financial viability, which most condos can be pretty mismanaged financially. And if your condo you're looking at is not on that list, you can have an individual approval, but it takes a long amount of time. And good chances are, if it's not already on the FHA approved list, it probably won't qualify to be on, to be an FHA approved condo. Now, it's not always true, but FHA only wants to fund loans for condos that have good financial management. Okay, they don't want the condo association to go under. That way, they then have to go pay for that loan if it results in a foreclosure. Okay, and then there's also a property flip rule with FHA. I know it sounds like there's a lot of rules here. If you're looking at a single family home, you're buying it as a primary residence, you're not going to run into any of these weird situations. But FHA is so flexible that people like to do a lot of things with it. So it's good to clear up what it can and can't do. So with the property flip rule, it's basically saying there's a 90-day period where the home, let's say somebody purchased the home, so they're the seller, and let's say they purchased it today, and then they flipped it. 2 weeks later, we want to go buy it with an FHA loan. That is not allowed. We have to wait 90 days from a sale to a new transfer of the deed to us. All right, FHA doesn't let these flips happen that quickly. All right, the only exception is if it's being sold by HUD itself, or there's a couple other situations where you'll barely ever run into these situations where you can get around this rule. But for the most part, if the home was already transferred title less than 90 days ago, you're going to have to wait out that 90-day period to be able to purchase it with an FHA loan. So let's talk about some example homes. All right, so here we first have a home in Columbus, Ohio. Right, super nice home, just remodeled, fits under our loan limit, which we'll talk about here in just a little bit, but $315,000, 4 beds, 3 baths, almost 2,000 square feet. And if we purchase this with an FHA loan, we'd be looking somewhere around $2,200 per month as a payment, including taxes and insurance and all of that stuff, with 3.5% down. We also have another example. This one is in San Diego, California. Again, this is under the loan limit, and it's $725,000. It's 4 bed, 3 bath, 2,000 square feet, and we'd be looking closer to $4,260 per month payment on FHA if we did 3.5% down. Okay, so loan limits. FHA does have loan limits, meaning you can't purchase a home with FHA above that limit. Now, there is a link to the lookup in the description. You'll put in the county that you're looking to buy in, and it's going to show you what that loan limit is for that county. So the new base limit is $356,362. This is an increase of over $24,000 from last year. And the way that you calculate what your max purchase price is you take the loan limit divided by 0.965. And that's going to show you how much your purchase price can be. Okay, so keep in mind when you see that number, like $356,000, that's not your max purchase price. That's your max loan. So we have to do a little bit of math to reverse it and figure out what our max purchase price is. Then with 3.5% down, that's our max loan. So just take the loan limit divided by 0.965, and that's going to give you the max purchase price. So we can see here with our low cost areas and high cost areas, what FHA has decided is their new loan limits for 2021. And again, you don't have to really worry about this too much. Just look on that link in the description, put in the county that you're looking in, and that's going to give you really detailed information about that specific county. Okay, so appraisal requirements. This is one of the really difficult parts about FHA is they can be pretty tight about what they want as far as the appraisal. All right, so an FHA appraiser is going to come out and they're basically going to see if it meets the standards of an FHA loan, and they're a lot tighter than conventional. So FHA is mainly worried about what they call health and safety, and they kind of can take this to a bit of an extreme, but they want to see structural soundness. Think of a home that's going to be move-in ready. If it has work that needs done, most likely you're going to need some sort of like FHA rehab loan to make that work, okay? It's most likely not going to qualify FHA if it needs some work done. And it is stricter than conventional because it's government insured. Again, they don't want to have to pay out to a lender if there's big issues. So that's why they have all these tight restrictions up front. So here's some common issues that you may run into that are going to be called out by FHA. Broken glass, chipping paint, these are 2 huge ones. I see these all the time on FHA appraisals where an appraiser goes in and says, here's chipping paint. We have to get this fixed before it can be funded with FHA. Plumbing issues, exposed wiring, broken HVAC, rotting wood, and wet basement or crawl space. These are some of the big things that I keep seeing come up on FHA appraisals that need to be fixed, all right? And if you have a good real estate agent, they should be able to spot these things before an appraisal happens. The last thing you want is an appraisal to happen, and then you have to get something fixed and then repay for a reinspection fee, which is going to be around $200 to have an appraiser go out again and make sure that it was those repairs are fixed, all right? So employment. FHA wants 2-year history of stable employment. Now, they even specify there is no set length of time at a specific job. So it doesn't mean 2 years at one job. It means 2 years history is what they want to see. They want to see that over the past 2 years that you can be employed, that you can make a consistent amount of income, and that your income isn't this big, roller coaster going up and down. They want to see some sort of consistency with your employment. All right. And even if you change jobs frequently, as long as it's within the same field, that's perfectly fine. You can change your job 6 times within the past 2 years as long as it's with the same company, as long as it's within the same field. So let's say we had, you worked as a teacher for 6 different schools. Maybe you had a move in between there. That's perfectly fine. Or you work for 6 different plumbing companies. Perfectly fine. Those are in the same line of work there. All right. And we don't have to be at a specific job for a set period of time. However, the longer we're there, the easier it is for an underwriter to use that income in a more consistent basis. All right. So it is ideal to be in a similar field if you're changing jobs. Now, debt to income ratio. This is going to change how much we can afford for a home. All right. And again, keep in mind, this is all about what a lender would qualify you for, not what you should take out. Okay. There's a huge difference between what you could get approved for and what you should take out for a loan. Just because a lender is going to give you money doesn't mean you should take it. Right. A lender is not a financial advisor. Right? You are your own financial advisor. You have to be in control of your budget. Just because someone says, here's a loan for $400,000 doesn't mean it's a smart choice for you. Okay. Keep that in mind before everyone gets angry in the comments. I don't make these rules. Okay. The bank is willing to give you a lot more money than you probably should take out. You just have to keep that in mind. So there are 2 different types of debt to income ratios, and debt to income ratios are just showing us how much debt do we have compared to our income. So a front end ratio is where we take the future housing payment, how much we might spend monthly on a home, divided by our income. So if we had $100,000 per year income, and this could be as a household or this could be individually, FHA will allow us to do 36.99% front end ratio. That's the maximum that they'll allow. That's a $3,000 monthly mortgage payment that they would allow on a $100,000 income. That's pretty significant on a $100,000 income. And our back end ratio goes up to 56.99% on FHA, meaning that you could qualify for up to $4,750 per month in total debt. Okay, let's let that sink in for a second. $100,000 per year income, that's $8,300 per month, right? FHA says that even based on $8,300 per month gross, they'll allow you to have almost up to $5,000 per month in monthly debt payments. Okay, FHA has so much leniency there. Again, just because someone will give that to you doesn't mean that you should take it on. So if we wanted to max out our debt on an FHA loan, we could purchase a home that's $3,000 per month and have an additional $1,700 per month in monthly debt payments, right? In payments to credit cards, student loans, auto loans, all of that stuff here. With student loans, FHAs can be a little bit tricky, mainly because they do not allow IBR. So IBR is just income-based repayment, basically where your student loan, your monthly payment is going to be based off of your income and not necessarily the loan balance itself. So conventional loans allow you to use income-based repayment, right? If your income-based repayment is $0 per month right now, meaning you pay $0 per month on your student loans, on FHA, they're actually going to make you use 1% of your balance in your debt to income ratio. So if we go back, to looking at these front end and back end ratios, having student loans is going to probably significantly reduce how much we can afford, right? Because if we took an example of, let's say we had $40,000 in student loans, that's a $400 per month debt payment that we have to include in our debt to income ratio. And your lender is going to do this for you, but it's just helpful to know that if you are on income-based repayment, conventional might be a better option for you if you're tight on your debt to income ratio. Now, FHA is interesting because it allows what's called manual underwriting. Most of what we talked about so far is all through what's called an automated underwriting system. And this is basically where it's a computer software that all lenders have access to, and they're taking all the information about you and your loan and running it through a software that says you're good to go or you're not good to go. Now, if the software comes back and says, hey, this has too much risk for the software to actually give an answer on, you can do a manual underwrite. And a manual underwrite requires a lot more documentation, a lot more work, normally a higher interest rate, and a couple other things that can be a little bit more difficult. And it will also change our ratio here for how much we can qualify for with what's called compensating factors. So I know this sounds a little bit tricky here. Your lender is going to take care of all of this for you, but it's just helpful to know that this is an option for you, okay? So a good example would be, let's say we went to go apply for an FHA loan and the underwriting software kicks back and says, we can't get this approved. So we could talk with the lender that does manual underwriting. And let's say our credit score was 580 and above. Well, our debt to income ratio is going to be capped at 40 and 50% front end and back end ratio. And we also need two of the following. We either need cash reserves, meaning extra money in the bank after we close. We need a minimal increase in housing payment. We need additional income not reflected in our income we put on our application, or residual income, meaning a lot more income left over compared to our debts. So basically here, don't get overwhelmed by all the details here. This is your lender's job, but it's helpful to know there are extra ways. If a lender comes back immediately and says you're not qualified, ask them about manual underwriting. Is that a thing that you do? If so, is that something that I could qualify for? And if they say, no, it's something we can't do, then maybe look at another lender who does do manual underwriting. That way you can get an additional opinion and an additional view with FHA and if you can qualify. Now, seller credits. Seller credits are when you ask the seller to pay a portion of the purchase price towards your closing costs. And this is negotiated when you get under contract. FHA will allow you to ask for up to 6% of the purchase price. So on a $100,000 purchase price, you could ask for up to $6,000 towards your closing costs. On a $200,000 home, we could ask for up to $12,000 towards our closing costs. Now, your closing costs are probably never going to be that high, but it is what FHA does allow here for what you can ask as a maximum. So some special requirements and features. We did talk about house hacking. This is super common on FHA loans, kind of in the investing world a little bit. Also, there is a $100 down HUD REO program, meaning if you're purchasing a home from HUD and you can just Google the HUD home store, find homes there. You can actually do a $100 minimum down payment instead of 3.5. HUD basically says, hey, if you buy this home from us, meaning it was a foreclosure, it was an FHA foreclosure, instead of doing a 3.5% down, you can just do $100 down. All right. There also is a 203K rehab loan, meaning if there is a home that needs work and it's not going to qualify through an FHA appraisal, you can actually finance the rehab cost inside of the FHA loan. You're going to run into a higher rate. It's going to take a longer time to close. It's going to be a more complicated process, but it is an option that you have available to you. Also, FHA is really common as, in my mind, a bridge strategy. Now, no one else calls it that. I call it that personally when I'm talking to clients, but anytime I run into somebody who has a lower to mid credit score and we say, we're probably going to need an FHA loan to get you qualified for this house, what I recommend is that they qualify with FHA to get the home, then they work on their credit score. Ideally, within 2 to 3 years, I'd like them to refinance into a conventional loan with a higher credit score. And I call this a bridge because in my mind, FHA really is only good as a short-term loan. I shouldn't be holding an FHA loan for longer than, personally, I would say 5 years is even getting to the point where it's like, we're holding on to this for a little bit too long. All right, so FHA is going to be given in 30-year terms, 20-year terms, 15-year terms, but you shouldn't be holding it on to it longer than 5 years, I think. What would be best is if you need to qualify with FHA, maybe because your credit's a little bit lower or you have a high debt to income ratio, then get that loan. That's perfectly fine. But now we need to work on a game plan to refinance into a cheaper loan in the future. And there also is down payment assistance programs that you can find. Again, they're going to be a little bit more costly. It's going to be a longer process to go through than just going, funding the down payment yourself, but it is an option that you have available to you. Now, refinancing. After you get this FHA loan, you can refinance through a process called Streamline. It's called an FHA Streamline refinance. And this is actually really nice because if you want to take advantage of a rate, a good example would be if you purchased a home with FHA last year. Okay, maybe your rate was closer to 4%. Well, interest rates have dropped significantly, and now it's closer to high 2%. So instead of doing a refinance where you need to recheck credit, recheck income, recheck the appraisal, and get the whole process done again, FHA allows what's called a streamline refinance, where they don't have to check credit, they don't have to check income, and they don't have to check the appraisal. You go through a refinance that's cheaper and a lot easier of a process. You can probably get this done within 2 weeks, and it's just going to take you to a lower interest rate. Now, you can also refinance from FHA to a conventional loan. Now, they're going to have to recheck income, recheck credit, recheck your appraisal, but the ideal goal would be here is that you had a higher credit score, so now you can move into a conventional loan that's going to be cheaper for you long-term, or you can remove that mortgage insurance premium when you hit 20% equity in the loan. Because again, keep in mind, for most people, mortgage insurance is not going to fall off on an FHA loan, and eventually we'll want to get rid of that. So now let's walk through a cost comparison. A lot of people just don't talk about the comparison of costs with FHA. So we're going to compare this with a 640 credit score. All right, now 640 is interesting because technically the minimum for a conventional loan is 620. So with a 640 score, there's a good chance that we could qualify conventional. However, conventional tends to be better for people with a 680 score and above. And in fact, conventional loans tend to penalize people who have below a 680 score with a higher interest rate and higher mortgage insurance. And so what I recommend for people is even if they can qualify for a conventional loan, if they have a mid 600 score, FHA short term is probably going to be a better option. So let's run through an example here. So we can see conventional, we're comparing is a $300,000 property. We can see the down payment on each. So conventional is 5%, FHA is 3.5%. We can also see the interest rate, how significantly lower the interest rate is on FHA. Again, because conventional tends to penalize those middle to lower credit scores, even though they technically can qualify. Also, our mortgage insurance cost is significantly cheaper by about $100. All right, we can see this monthly breakdown. I put in an estimate of taxes and insurance in here. But looking at this chart tells us a lot about these as well. We can see if we took a 640, if we had a 640 score and we went conventional, over a period of 20 years, we would be saving $73,000 by going with FHA. Okay. Now, what this doesn't account for is you increasing your credit score and then getting a conventional loan. But what ends up happening is we can see FHA is actually a cheaper option, even though it has mortgage insurance. Because we get such a lower rate on FHA, it's a cheaper option if we have low to middle credit. Now, ideally, the best thing to do would be to get the FHA loan, take advantage of the cost savings within here, within this period, right? There's a child screaming outside. Take advantage of the cost savings here. And then when your credit has increased, that's when we want to refi to conventional. And when we refi to conventional, we're not going to get this conventional loan. We're going to get a conventional loan that's probably going to be charting closer like that. All right. Where we're going to get a lot more cost savings compared to FHA because we have a higher credit score, which is what conventional loans tend to want. Now, let's also talk about the seller perception, because when we're using loans, it's really important to keep in mind, how is the seller perceiving our offer? Because we're not going to have a good chance of actually getting the home if we come in with bad financing. So sellers see FHA loans as less attractive than conventional. However, they're more common than other types of loans like VA and USDA. So if you are coming in with a FHA loan, it is good to maybe ask for less seller credits, maybe to ask for a shorter closing time. Do things that would make your offer a little bit more attractive, knowing that you're competing against cash and conventional offers. Even things like writing an offer letter can be really helpful if you're coming in with an FHA loan. That way the seller, we want to give the seller confidence that we can still close on this loan, even if we have to use an FHA loan here. And then also, how do we apply? So we don't apply with FHA. You can't actually apply with FHA, but you can apply with pretty much any lender. Almost all lenders are going to allow you to use FHA, no matter who it is. If it's a broker, a credit union, a bank, a direct lender, they're all going to be able to give you an FHA loan. So in my recommendation is to shop with 3 different types. Shop with a local credit union, shop with a local broker, and then shop with a direct lender or a big bank. That's going to give you a really nice spread to see the different options that you have available to you based on different types of lending organizations. That way you can see, they're all FHA loans, but they're all going to look slightly different depending on their rate and their costs based on the company itself. Okay, so if you want to learn more about the 4 main types of loans, this playlist over here is going to give you some insight so you can choose the best loan to save the most amount of money moving forward.